Okay, so I thought I'd start off this talk a little bit telling you about talking about what's happening in the world, what's happening in MENA, and what we're seeing around here. Kind of sets the tone a little bit for what investors and what we're looking for. So when you look at the world and as we see it before, if you think about like when we were younger and before all this technology has come into place, we had traditional businesses. You had hotels, you had banks, you had shops, you had insurance, you had, TV. That is not the world we live in now, and that's not the world our kids are gonna be in. In our lifetime, we've seen probably the most advances in technology than anyone will ever see in their lifetime. And you know what? Maybe it may be like anyone in the past, but in the future, this is going to be a drop in the bucket in terms of what we've seen in our lifetime. Like technology will just keep advancing, and that's just the way we think we're going to see it. So hotels are now done by Airbnb. Banks are now all online, like with Wealthfront and Sarwa, and you have shops that are now everyone's shopping online. Insurance is no longer done the traditional way, and TV is now almost completely streamed online. You got Netflix and everything. Like the world is completely different. There's been disruption everywhere. And then we look at there are a few ways at which we look at the world is at what is consumer behavior, how are our businesses working, and how do we interact. And what has happened in 22 is, as poor Miles had to experience, COVID hit. So what does that do for consumer behavior? What do we look at for consumer behavior? You look at product discovery, ordering, payment, customer service, banking, and basic admin completely changed. Our consumer behavior is completely changed by COVID in the last year, and many of these behaviors will be sticky and will remain. Like I don't think I'm going to be going to the grocery stores that often. I love shopping online. That I don't need to go to strain myself to pick up water anymore, or pick up toilet paper. It gets delivered to my front door, and I'm extremely happy. Things are being done faster, more efficient, and even stores don't need huge stores if half of everything is being delivered. So the world is being completely different based on consumer behaviors. The way we work is very different. Remote working places, which it means amazing things for people that don't live in the big cities. So what does that mean? You can pay people less. They don't need to pay San Francisco wages, don't need to pay New York wages. You don't need to pay big, Dubai wages or something. You can live anywhere in the world and work for great companies. The way we interact, I think, is quite, to be honest, quite sad. We talk more, meet less. I miss the meeting, the face-to-face meetings. I miss the physical contact. I miss the relationships you get there. I think a lot of that will return, but there will be a lot less travel for work. There will be more work done on Zoom, a lot more digital signatures, a lot more like all of the inefficiencies that we had before will be gone. And probably one of the best things that came out of COVID is more and more content. We're seeing across the board, even now with Clubhouse, we're getting amazing content, amazing speakers, and it's accessible for everyone. It's not exclusive anymore. And that I find has been one of the great benefits of the COVID era. Obviously, going more detail into COVID, everything has changed. Governments have been reacting, and this is completely changing the way investors think and the way investors view the businesses they want to invest into. Tech companies have probably been the investing environment, and tech companies have not seen a slowdown in 2020. And in fact, we've seen many of our companies grow. And mainly those are the ones that can scale, that can really reduce their costs and scale, or kind of move up and down very easily without having to, without big CapEx costs. A lot of the tech companies that we've invested in are very software based, so they can go up and down as maybe they're very nimble. Now things going contactless, digital solutions, digital signatures, KYCs, everything. This has been a phenomenal environment for fintech and fintech enabling companies, health tech, ed tech, everything. This whole new environment has changed significantly. And as we see the vaccines roll out, a lot of our companies, even the ones with like more of a physical presence, or especially logistic companies that are moving people around, we're seeing that they're starting to see some recovery. So the world is significantly changing. So who are the winners and who are the losers in this new environment that we live in? VC has been in a crazy year. Like the MENA region has probably seen, it's been a record-breaking year for investment. We haven't seen any decrease in valuations. We expected it, and asked me 1 year ago in March when everything was kind of, when the world was crumbling down, we expected a lot of our valuations to drop. Absolutely not. They've seen the most funding pump into MENA in 2020. But what's interesting to see is that the number of deals have dropped, but the size, the dollar number has gone up. So that means we're seeing companies raising some larger rounds, which is just showing our ecosystem maturing. And the losers are unfortunately the brick and mortar businesses that aren't able to adapt. So looking at MENA, I think lots of people have seen these, a lot of the players. So it's, as you're a company here looking for funding, it's really important to get yourself familiar with who does what in the ecosystem and who can help you. And spending a lot of time looking, so understanding who you're looking for. Like, are you looking to raise from angels? Understand who the angels are out there. Are you looking to invest from VCs? Are you growth stage and large and looking to invest from bigger like family offices, and to get to know the environment, so you know who to talk to when you're talking to the right people. A majority of the investors are in USA and KSA, sorry, UAE and KSA. So may require some trips out here. The UAE and a lot of the KSA investors come to Bahrain, but everyone's investing all over the place in the region. But you may have to take some trips out to see investors where they sit. What's the amazing thing is what's been happening in MENA is the flow of capital into our ecosystem. We've had government or a kind of developmental capital that is coming in to our ecosystem, which has been kind of a top-down, like they call it trickle-down approach, where you've got some big guys, some sovereigns, putting money into the ecosystem and funding the funds building fund of funds who then invest in the companies. This is a great way to build the ecosystem, build funds, let funds get, build themselves, build a track record, and have the companies get funded instead of trying to give them to the companies directly, because the funds are where how that ecosystem will grow. So I really, really love the way that the MENA environment has grown and the developmental capital that's come in. So this is a great time to be building a business in this region, because there is capital for those that are doing well and committed and are looking for capital. Some statistics, and you probably like, I'll say this, I think most of this is from the Magnet report, where a lot of the funding sits. As I mentioned before, it was a stellar year in 2020, but the number of deals are down, but the amount of capital is in, showing a very a maturing of our ecosystem, which is kind of fantastic, and what we want to see, that we get like larger deals are getting done more. We don't want to just see early stage funding done. We want to see growth stage rounds being filled, and because that has in the past has been a challenge for MENA, is to get the big C funding done. Has been challenging because there hasn't been many people in the past that were able to do those rounds, but now that's changing. And one of the reasons why that's changing is that we're getting more exits, which is, huge. We don't have the Instacart exit on here. I should have added that, but there's exits, and that's what when most, like, if we're fund managers and we have LPs to answer to, who, basically we take their funding, and they always ask us where are the exits. And and now we've got some answers. We're seeing some really good exits happening. People are paying attention to the region. We've got international capital coming into the region. So this is no longer as big of a concern in the past as it was.
Sonia, do you mind if I just jump in here? Do you mind going back one slide? Yes, here, the top 5 industries by number of deals in 2019. I don't think we're considered health tech. We are more fitness tech. So that's fit tech, right?
Yeah.
So I don't see that here. So are we like others?
Yeah, it may fit in other, it may fit in health. I have to look to see what Magnet defines health tech, but usually I would put it under something like a wellness, and a wellness area. So it may, because they've qualified other as like 26%. So likely that's where it lies.
Okay. Yeah. Maybe later on in your what would you call the lecture? If you can, if you can probably maybe share what you think about like fit tech.
Yeah.
Yeah. So whenever you see it's a good time, you can, if you don't mind.
Yeah. All right, just going through here. This is just looking at investors by ticket size. We still see majority of investments happening at the early stage, which is nice for you guys, because I think most of you guys are quite early. So about 48% of the investments are still done in the early stage and done by angels and seed funds. So we've got a lot of seed funds and acceleration stuff here. Okay, so the biggest thing is when you're fundraising is kind of understand where you sit and who you should be fundraising from. Not always an easy task. So for example, we're a VC, and I was speaking to someone the other day who's raising 500,000. And I was like, look, you shouldn't be talking to VCs if you're only raising 500. You should be talking to friends and family. You should be talking to angels who are writing smaller checks and can really help you on, like just 500 is just not big enough of a round for some VCs. And so it's important to know who to talk to at what point in your lifespan. So if you're raising a small round, you should at least start with your friends and family. Start with your bootstrapping yourself your own investment as much as you're comfortable with, and then as you grow, you should be talking to the right the kind of the right entities. And the VCs come in pretty early anyway. I see a lot of them do fund. We've got a lot of seed VCs here, but they're usually looking for like $1 million round or something, so that they can get like a significant stake in the business. But just know your investor is kind of a really important thing, and know who you should be approaching and what they do. So do a little bit of research on the investor before approaching them. What to bring to the table when you're fundraising? Obviously, you need like a really great pitch deck, and that's an art on its own. To be honest, we've seen so many pitch decks. When you have a portfolio of 180 companies, we've seen so many pitch decks, and so many of them are horrible. And some of them are fantastic. And we do judge a company a lot. We're like, when we see a great pitch deck, we share it with each other, our team. We're like, look at this deck, it's phenomenal. And it's a matter about hitting the main topics of getting to of what exactly an investor needs to know, doing it in a clear and concise manner, doing it where it captivates the investor, is not overly complex, doesn't have a lot of words for no reason, it's very clear and concise, and it's a science on its own. And I'm sure through the accelerator, you're like through FinTech behind FinTech, you're getting some coaching on that. But I'm like, it's a huge thing for us, is to make sure that you got your pitch down right. And a lot of things, sometimes we talk to a company, and if you can't explain your company in like a couple of sentences, you gotta refine this pitch again. Like, you gotta have your elevator pitch down pat. You gotta be able to let me know why this is a good company, what, and why I should be interested in investing it really in a couple of sentences. And tell, like, so basically what is this, like, this opportunity, I should feel like the opportunity is huge just off of a few sentences. And that's also very important. It sounds like a simple thing, but it's not always done well. And I can't say I would do a really good pitch myself, but I know a good pitch when I see it, to be honest. And you know what, at an early stage when we're investing, because we do invest seeds, we're seed, Series A investors, a lot of it is founder team bets. And so and there is a bit of an X factor when it comes to the team. Like, when we talk to a team, we want to make sure they know what they're doing, they know their business inside out. There's no question on understanding the business plan, understanding their competitive environment. Basically, if I should be able to ask any question, you should be able to answer it in a clear and concise way. And like, if you don't know the answer, you're not going to fumble it. Like, oh, I'll get back to you on that one, and then now you'll know it for the next time. But you have to, like, it just has to be. I can't even explain to you how much we base our decision on the team, because your business may pivot. Read the Airbnb story. Obviously, everyone knows the business pivoted significantly, but the team was phenomenal, and that may happen, especially at an early stage investment. But if the team is good and the team can adapt and the team understands the environment they're in, we're happy to support. And we'll continue to support. So you'll often see sometimes investors will back founders twice. They backed them on their first deal and they exit. This happens a lot in more mature markets where you have more exits, and then they'll back them again, because the team matters so much. Having your information ready to go if an investor is interested is extremely valuable, because that means it shows you're serious about your fundraise. So having a data room ready to go, I've listed some of the documents you should include there. Extremely important, because if I'm talking to a company and I say, okay, do you have more materials? Do you have a data room? I don't want them to say, oh yeah, we're in the process of getting it done. You should have it ready to go and then talk to investors. So just get all your ducks in a row before moving forward. So what do we look for? I'll go into the kind of bit detailed about what we look for in a company, and feel free to ask any questions. But before I get into this, any questions so far?
I do have one more question.
Yeah.
But can you go back to the slide right before this one, please? I meant the one with the documents that you guys, yeah. So for the shareholder structure, okay, like for our startup, I actually seeded like over $100,000, over like $150,000 of my own funds. And I just wanted to know if a VC or like a angel would be comfortable if I like when we actually get like further investment, that if I put like an SPV for that investment as a separate company, and like it would be like so it would be like the company plus the VC plus that SPV holding shares. Have you ever seen that before? And what do you think of that?
Yeah, no, it's fine. So you put in, so if I understand correctly, you put in your own capital, let's say it was 100K into an SPV, which then invested into the company.
Yes.
Okay. And you did this early on. So you just essentially got shares because of the capital you put in.
Yeah, so the SPV would get some shares, let's say like 20% or something, and then the rest, of course, whatever we agree with the VC, and then the rest is whatever is owned by the company and whoever else owns shares from the other co-founders and stuff. So well, that's cool, right?
You did this 100K investment before you got VC money, right?
Yes, that already happened, but I did not actually change anything with the company structure. So I will have to.
Yeah, I would.
Just I think like cover. Can you say that again?
Yeah, if you want to get shares for the capital that you have put into the business already, you should do that before you go out and fundraise again.
Okay, but would
Now,
that be like, would that raise like any flags? Because it's just like, it's the other the SPV is owned by myself, you know?
Mhm.
So it's just
No,
like,
it
let's
doesn't.
say,
I'm guessing you have other co-founders, right? So, and you
yeah,
put in an additional amount of money that they didn't put in, for example. So
yes,
you're getting
yes.
compensation for those shares. That's fine, but you would do it now as opposed to later when the VC comes in.
Okay,
You would already
sounds
be on
good.
the cap table before.
Okay, sounds good. Thank you.
Okay, so if we're looking a bit at the criteria, first thing we look at is the market big enough? Like whatever problem you're solving, whatever if you're in fitness or if you're in mental health and you're coaches, is the market big enough for it to be like $1 billion addressable market? Because we're looking to hit it. Hit it out of the park. And that's huge. So if someone comes to me and says, I'm building, you know, cat houses for a very specific type of cat, I'm like, okay, well, that's not a big enough addressable market for me. I need to, are you building it for all types of cats? They're like, no, very specific type of cat. And they're like, well, then that doesn't really help me. You want to do something that has a huge addressable market and potentially can expand into other geographies. So I'll use an example that we invested in a company called Onfido. It's in the background of a lot of companies where it's a B2B software where you can do online KYC checks. It sits into a lot sits underneath a lot of companies. You don't even know that you're using the software. We love the business.
Sorry, most of the actually a lot of the banks in Bahrain use Onfido. Actually, we've seen it quite a lot.
Yeah. And we're investors in the company. We love the business for many reasons. The addressable market is huge. It's a very software business that is not very heavily regulated because it's enabling, it's enabling banks by helping with with what their checklist of KYCs, so they can expand across geographies very easily. It's all very software and tech based, so not a lot of heavy capex. Like it's not a scooter business where you have to buy scooters and you have to amortize those scooters over the life. It's really just a software business with the technology behind it. Barriers to entry are that's a concern because they're not huge, but if you built a really good tech product there, then that brings up the moat. And so we love companies that are like this, that are completely software based, can go across geographies, and are not in a heavily regulated environment. Look, we're fintech, so we do a lot of heavily regulated environment, but that business we love for those reasons. But it has a huge addressable market, and that was very intriguing to us. So trying to be in a space where the potential is huge is what we look for. Really, one of the first things we look for. Because if you want to, if you're trying to build $1 billion business, you need to be addressing at least $1 billion in your addressable market. The team, obviously I mentioned this before. These are the few of the things that we actually look for. Does the team have industry experience? Are they technical founders? Are they more people persons? It's hard to find both, but you want to have your founder team or your your senior team to be complementary set. So someone's a technical guy, but you've got one guy that can rile the troops and really build a big business with a big vision. So it's really important about surrounding yourself by complementary people. If you're a repeat entrepreneur, that's always a plus. We've invested in repeat entrepreneurs, so we've got good experience there. You're obviously full-time dedicated to the venture, and this is like your entire life mission at the time. And you can tell that by speaking to an investor that they're very passionate. They're very passionate about their business, and they have to be adaptable. If like the COVID hit, and if you're not an adaptable founder, you're dead in the water. So it's really, really important to be able to adapt with the times, and you can see that in a good founding team. Then we move on to a few other criteria that we look at, I'm kind of actually saying it in order of what's important to us, and then the product is hugely important. We spend more time with it as we go deeper into diligence. But for us as early stage investors, it's always nice to see that the product is in the market and has an adequate level, product market fit. Like people are using it, people are booking money, you got some revenue. There's and there's a clear differentiation from the competition or a previous way to do it, right? Like the product has to be fantastic. Like when you think about like Uber coming in, Uber's product was far superior than taxis. You know, the way taxis work, and that made it very compelling. And so you want to make sure that there's a clear differentiation from what's currently out there. And then going into more detailed here, like we do like more product diligence. We use the product, we Google the product, we looked at where they are now, what their growth potential could be. Like, can they add extra features that will add extra revenue? What's their roadmap? And then we spend time looking at the tech. Very important to be, if you're in a very regulated environment, know how to be compliant and your regulation. And for us, we prefer to already have be regulated or have your licenses in place. It's really, really important. But if you don't, then knowing what needs to be done, especially in the markets that we're in, because if you're in Bahrain and you want to go into Saudi and UAE, you got to know the regulation in each one of those environments that you're looking, those jurisdictions that you're looking to be in. So that's definitely something that, it's an easy thing to just understand and just go out and figure it out. But and it goes far away with the investors, because they know exactly what you need to do to be regulated. These are a lot of the key metrics that we look at: revenue, burn rate, bookings, ARR, your profit margins, and I'll go into some of the details of profit margins later. But we look for strong unit economics. Your ability to get customers doesn't cost too much. You're not just paying for customers. So we spend a lot of time looking at the metrics and the data behind the company, for those that have it. And then moving on from your product and some of those key metrics, we look at relationships. So who's currently in the company as an investor, because we look at that because there's, for many reasons, there's signaling in there, and a lot of times the investors are really kind of the wings beneath your wind. I like to say, because they really can help the companies build and grow by making proper introductions, potentially being clients of themselves, and bringing in good guidance. And some of them will take board seats. So we look to see what the relationships this company has and how can they use those relationships to grow. And then we also look at, do you have a solid client roster? Do you have a clear sales pipeline? What's your conversion for your sales pipeline to actual paying customers? So we spend a lot of time looking at these type of relationships that a company may have. Business model is also very, very, very important. As I was mentioning, we're on Fido. The reason why we like it is because it's very software based, not CapEx heavy. Ability to grow and scale is important. Has strong positive gross margins, and so these things were important to us and what we looked for in that business. And actually, if I go back and I use Fido for everything, even relationship wise, before with the round we came into, Salesforce and Microsoft Ventures were in the same round, and those both are potential acquirers of the company, which obviously made it more compelling. So there's many reasons why we like the business, and they fall under these types of criteria. Deal terms are really important, but to be honest, when you're speaking to investors, you may not have your deal terms set yet. because usually it's set by a lead investor, or if you're early on, sometimes it's just easier just to raise with a convertible note where you agree upon like the valuation cap or discount. When I think you've already done sessions where they've explained those to you, that and how the different mechanics work. But the deal, we will assess a deal based on the terms, but you may not have them set as you're speaking to investors. Those are things you negotiate with the investor. Okay, so what will VCs ask? So there's a lot of resources out there with, you know, lists and questions that you can go through to see what are they going to ask, what are the questions, and you don't want to get tripped up. So it's good to do this research and actually spend the time to go through a lot of these checklists. So here's like a list of a few like lists that you can go through of questions. We pulled up one of them from Forbes to see these are the 15 key questions that Forbes says VCs ask, and I think they're pretty bang on. Is there a great management team, which we discussed? Is the market opportunity big? Do you have positive early traction, which we talked about as well? Are the founders passionate? Do the founders understand the financials and key metrics? It's not even like you don't even have to agree finance. You, the founders, need to just understand the business very, very well, and that's a key thing for us. A lot of times we get referrals for entrepreneurs or referrals for companies, so we trust a lot of referrals. So we will have conversations with companies because it was referred to us. So that's a lot of times if you're speaking to an investor and you have someone that can give you a warm introduction, always far better to have the warm introduction than to do a cold call yourself. Because it comes with a certain amount of credibility when someone says, "Hey, talk to my friend. This is a good guy. This is a good girl," and so you'll likely get another meeting just with a referral. Is the initial investor pitch professional, interesting? We talked about that. The pitch is hugely important, and I can do a session alone on the pitch alone. So it's your chance. It's your one to make a first impression. It's got to be good. What are the potential risks of the business? Why is the company's product great? How might capital be used and what progress will be made with that capital? That's an important one. A lot of investors will ask you what's the use of capital. So they want to see that their capital is not being used, I don't know, to pay back old debts that you have in the business. They want their capital to be used to grow the business. So that's a question that investors will often ask. Is the expected valuation of the company realistic? I'm sure you'll have sessions where you go over valuation, but this is the sticking point a lot of investors will spend a lot of time on. Does the company have differentiated technology? What is the company's intellectual property? Do you own your IP? The financials, and if you have it's just a clean legal setup, and that's just a check the box thing. But if you don't have a clean legal setup and compliant with your applicable laws and you're regulated, it can be a game changer. It just does not look good for a company. What I tell companies when I'm talking to them is that when you're talking to an investor, they are assessing you literally from the first communication, whether it's an email, whether it's a call, whether you met them at a networking event, or whether somebody introduced it to them. You're being assessed from the first second that you speak to them. So all your communication should be polite and thoughtful. You should know your business before you're even talking to them. Everything is like, even the way if you're spelling mistakes in an email, people will judge you on that. If you don't have a clean professional deck, people judge you. If you don't have a data room ready, or it's not clean and well done, people will judge you on that. They're judging you every second away because they can. They don't have to give you their money. You have to convince them to give you their money. So you got to make sure you're good. It's a lot of pressure, but if you do it right, it's not hard to do it right, but just with a little preparation and making sure you're ready. So that's the pause right there, because that's just like the kind of high level what we look for. I'm going to go into detail now more on how we look at companies and how we're hunting for unicorns, but I'm just pausing right there to see if you have any questions on some of the stuff that I covered so far. And I can share this deck with you later so you can have it. Okay. So we're investors and we're looking for unicorns, to be honest. And I'll explain to you why. So I'm just going to skip forward a bit in my deck to say why. Okay, if we look at if you're talking to a VC investor, you first. I always think it's important. Any meeting you're into is always important to see what motivates the person that you're talking to and what motivates them to do what you want them to do for you. So if I'm talking to my child and I want him to eat his dinner, I have to think of what motivates him, and I try to get him to eat his dinner. So for me, as you're talking to an investor, you have to look to say what is motivating, what motivates this investor, and how can I help that investor get to where they want to be. The investor is a GP like myself of a fund, has LPs that they have to answer to, that they have to provide a return for example. I also have LPs on my fund that are developmental capital, which I mentioned at the beginning, and they're looking for more ecosystem building. Are you building jobs in Bahrain? Are you building jobs in KSA? Are you finding female partners? So it's always important to understand where the VC is coming from, or where the investor is coming at, what they're looking for, and then so you can cater your pitch towards that. If you're talking to a VC, so if we forget about the developmental capital for a while and those goals, if you're talking to a VC that's purely financially driven, we look at they're trying to get returns, right? Let's admit VC is a risky game. You're gonna, especially early stage, you're gonna invest in many companies. A lot of them go into zero. You're hoping to get a few ones that pop, and hopefully those return the funds. Understanding the numbers behind it is really, really important. So the VCs are really looking for a home run. They're not looking for, I'm looking for ones that I think they can get a decent $100 million exit. That's not what they're looking for when they're looking to fund something. If that happens, it's fine, but they're looking for a unicorn. They're hunting for a unicorn. And I'll explain to you why. If we look at a case study at Kleiner Perkins' first fund that they did in 1972, first, Tana Tech fund they did in 1972, their fund size was 7.5 million, and they had wrote 17 checks and out of that 7.5 million. And so that was an average of like 400 something per check size. That fund returned 345 million. That's a phenomenal return for a fund, and a MOG of 46x. This is phenomenal off of 7.5 million. But how did they do that, right? Like how did
Sonia, can you just so it's 46x, but in what was the period of time?
Oh, it was, I think the fund life went up to, I think 1986 was the period of time.
So it's like, it was like over 5-7 years, 10 years?
I think 1972 was the funds, and then
okay.
they exited in 86. So it was a regular fund life. But if you look, this is what happened with their portfolio. They got 90% of their returns from 2 companies, and the rest were okay. Like some of them went to zeros. Some of them were kind of a little bit like lower than what they held at cost. Some of them were nothing, but they got majority of their return from two investments, and that shows you that a VC understands how this works. A lot of their companies are gonna go to zero, but they're looking for a home run. So when we're talking to people, we're not looking for mediocre. We're looking like, can this guy or can this girl give me a unicorn and give me like knock it out of the park? So how do we find like a unicorn? It's not an easy task. Like if you actually think about what it takes to become $1 billion company, it's not an easy task at all. You're looking for exponential growth instead of linear growth. So we're looking for companies that we can see this happening, the orange line, not just a regular, like a linear line. A linear line is good, but that's not what a VC is looking for. A VC is looking for, can you show me exponential growth? And if you look at a lot of the unicorns and the time to unicorn, this is like the time it took them to get to a unicorn status of $1 billion company. It's all exponential. It's all exponential growth. So like this is what kind of motivates us and what we're trying to find, like what we're trying to hunt. How does a company
You
go?
want to know what I'm trying to find?
Sure.
Sonia, do you mind if I just share something?
Yeah.
My worry is after we become unicorn, I need to find the Sundar Pichai to take over so I can, you know.
Will. I don't think you'll have any problem being able to hire a fantastic leader so you can retire. I don't think that will be an issue. If people are valuing your company that high, definitely you'll be.
I think
you'll have no problem hiring.
take things one step at a time. I
Yeah.
think Sundar Pichai, like at that time, I think he might be available. You don't know what's going to happen, and so on. So just like ease into it.
Sure.
So if you actually look at the numbers, is how do you get from zero to $1 billion company? In order to get to $1 billion company in 5 years, you have to grow your business 4x year over year. That's a lot. That's a lot. So it's not an easy task. So you want to build a business.
Excuse me, Sonia. Yeah, can I ask you something?
Mhm.
When you're talking about exponential growth, are you talking on the sales or on the profit? Because
Well,
most of these.
this is what we're showing here is the value. So the value is growing exponentially.
But what about the profit? Does those companies actually make a profit or not?
Yeah, I'll get into that too, because you're right. Like Uber grew and Uber wasn't profitable, but somebody found it valuable. It's not like so in VC. You're right. There is a huge difference between what is profitable and what people value in the company. If you worked in PE in the past, you would, find a business. You're like, okay, this is a profitable company. I can grow it. I can find efficiencies here and get more profit out of it. Very clear on how to build a business in the private equity state. The VC world is completely different. You have people buying companies like WhatsApp that has not made zero money and sold for billions of dollars. So it's a very, very different environment. So when we talk about value, it's really how much people are willing to pay for whatever your business is offering. In WhatsApp case, it was users. So it gave them the access to the user base. And it could be different in different scenarios, but it's really the value of the business. And understanding the value of the business is also another session where you're actually doing a whole valuation analysis of it. But at the end of the day, the value of your business is really based on supply and demand. Who is someone willing to, the price is set because someone's willing to buy your business for that price or invest in your business for that price. Really no other thing. And we will look at create drivers for value. We'll look at revenue as a growth number. We'll look at profit as a growth number. We'll look at gross margins as an indicator of value. And we don't, there's no one magic number everyone looks at revenue or everyone looks at profits. We look to value a business, we look at it in 5 or 6 different ways, come up with averages, come up with ranges and then literally say, okay, here's where I decide I'm comfortable to paying for this business. And basically a lot of the times is that we look to say, okay, I want to buy a business and they're trying to value it at $100 million. I'm like, okay, fine. You think you're worth $100 million, but I'm an investor. I want to see a bit. I have to, if I'm going to invest in a business at $100 million, I have to really think it's going to go to $1 billion because I want to be a benefit of that growth. If it's really only, if I think it's going to, top the value is going to top at a 300. If you look at the market size, they're never going to be able to get enough revenue above that no one will value it over 300. Or if there's many reasons why, you can cap at your value. I won't invest in it. But if I think if it's going to go to $1 billion, I'm really looking at my different, where's my entry point and where I think it's going to exit. And that's that drives a lot of an investment decision. So here, this is just a matrix of the value of the business. And for a company to get to $1 billion in 5 years, you need to 4x your value every year. So that's a huge number. So that means you need to be showing either revenue growth or profits or something growing significantly every year for 5 years to get to $1 billion. And so in WhatsApp case, it's the users. Their user base grew extremely fast. So they became, unicorn grew extremely fast. So there's got to be some value to you that someone's gonna value for $1 billion. But you're talking exponential growth means, we were talking about 4x year over year. And so when everyone's talking about, okay, which was better, revenue or margins? And I'm going to say it's both. They come hand in hand. So to get to $1 billion business, you got to show, okay, so first of all, when we look at a business, quite frankly, I like to invest in businesses that have, margins of 50% and above. And I actually talked to investors and will never invest in a business that doesn't have margins that are less than 50%. And if you look at on Fido, that's an example of one, that has extremely good margins. Their numbers are public. They release them, so you'll see that they've got extremely good margins. And those are the types of businesses that I find are phenomenal, and those are the ones that I think can actually become unicorns extremely fast. And businesses with large margins have low capex. They're able to scale really fast. They're able to usually go across geographies because their market is huge. And they usually tend to be software type businesses that have larger margins. So if we look at the numbers, if you're seeing, like these are just showing you different scenarios and your numbers growing, but you want to see like year-on-year growth, and I'm talking revenue now, and margins growing. So as your revenue grows, you want to be showing your investors that your margins are growing at the time because you're building efficiencies of scale, and those are working into the margin. So often when we look at a company, their financial projections will often show their margins growing with time because they're building efficiencies in that business, and that's completely natural. But these are drivers of growth. It's actually showing that, your business is profitable, and as you grow the business, it will be more profitable. And this is like, okay, this is what I'm looking for in a business.
Sonia?
Yeah.
Hi, sorry, this is Yusuf here. I'm part of a team called Towerfly. We're sort of pre-seed. And you touched on a really interesting point. When we were building our model, we found that obviously the first few months while we're still sort of ramping up, our margins aren't that great. By the end of year one, we're looking at around 35% or so. And probably by year two, we would cross the 50% mark, but we're not there yet. So when we're approaching investors and considering we're pre-seed, right? So how should we be presenting our gross profit margins? Because obviously if I'm doing a 1-year forecast, anything more than that at this stage might be seen as too ambitious, or you're reaching too far ahead. We're pre-revenue.
Yeah.
So
No, that makes
any
it look.
advice here?
Yeah, absolutely. So if you're looking at growth margins, so it's actually not uncommon to just do a 5-year forecast. And to be honest, investors will discount the last few years completely. But at least for us, a forecast will show a lot about the founder. If you're too conservative with your projections, we judge the founder and saying they're not ambitious enough. If you're too ambitious, we discount them and don't use those numbers. But you're damned if you're damned if you don't. But we like to see those projections so we can understand just the numbers a little bit. The gross margins, you want to you're 35 now and you want to go to 50. It's just a matter of showing how you're going to get to that. You're going to literally just show when you have a breakdown of your costs, where your costs will reduce as a percentage to get that extra 50%. And just so you know that you show the investor that there's a path to get from where you are to a higher margin is important. And also projections are what they are. They're just projections. And I'm an actuary, so we do projections for everything, and everything is an assumption. So assumptions are important, but it tells us a lot about the company and how they're thinking, that they've thought through everything. They know their numbers correctly. They understand the cost of their business. They understand where they need to spend time and how they need to get higher margins. So one of the businesses, for example, that we invested in, they have extremely good data that they could pinpoint which of their clients gave them better profitable revenue and which ones did not. And then they started changing their entire concentration on the sector of clients that give them higher margins as opposed to just revenue. Because you can, to be honest, there's some customers that if you pay money, you're almost just buying the revenue, like, because there's nothing comes down to the bottom line. There's no margins there. So that company ended up, what they're doing is they actually started, like they peaked in the middle of the year, let's say July, revenue wise. Then they switched their plan and started focusing on the sectors or the clients that produced higher revenue. And we actually saw the top line revenue go down, but the profit went up. And we valued that more because we see they clearly understand their business, understand their market. And there's no point in just literally just trying to buy top line dollars, top line revenue. So the investors notice this and they'll spend time looking at this. So for you, it's just like knowing your business and knowing your client and knowing your data and capturing as much data as possible is key.
Fantastic. Thank you so much.
Another few things that we look at, like that I didn't cover yet, is kind of, are you doing something that's unique? Are you doing something that did not exist 3 years ago? Like, when Uber came in, it revolutionized the way people booked things, between cars and getting food delivery, everything completely changed everything. Is your business doing that? Did this business exist 3 years ago? And are you doing something that is different? You're differentiating yourself from, the past. You're solving a problem. You're making the world a better place with the technology that you're building. And is your product 10x better than the existing alternative? Because that's what we're looking for. We're like, this product is so much better. I must invest in it because it will. And this is the Uber again. Like Uber was 10x better than trying to go out and hail a taxi, right? Which in most cities was extremely hard to do because there's not that many taxis. So that you'll have to show that your business or try to create a business that is 10x better than the alternative, and that's what that's what we look for. That's what we're trying to find. And as I was saying, the X factor is definitely lies with the founders. And are you showing passion? Are you in and out of the business? And a lot of times when I say to my colleagues, I met a company today, you have to meet them because I think we want to progress this through our process. The founder is really switched on. I really liked it. And it's really just, a lot of times it's a founder bet, but they have that X factor and that's a lot of times how it goes. We're like, you guys have to meet this company. They just know what they're doing. They've got it. I think they've just covered, they know exactly what needs to be done, what markets to hit, and they have that X factor. So you want to be the person where I tell my colleagues they have that X factor. So that's all I've got for you. Just some document, I put in an appendix, some documents you might want to put into your data room and, keeping it very structured, but that's all I have for you guys today. Do we have any questions that I can answer? Sorry, this is a normal part of my day is having him run in.
ربنا يحفظه إن شاء الله. Okay, so now, Sonia, if I can ask you a question.
Sure.
Now, please. Now, if a company invested too much in technology and into building in the first 2 years, and also in building the team, now without a huge let's say revenue, because the focus was all on the technology and the fitting a solution to the market.
Hey, Papa.
How VCs see this?
So it depends on the business, and we look at it different. Look at it different ways. So if you are a business that requires a lot of infrastructure and building before you can launch properly, we notice that, and we know that, and so if we're putting in dollars, we'll say, what are you going to use the dollars with? You're like, okay, we've already built the infrastructure, we have the team ready to go. Now we're ready to launch, and we're just ready to get out there and start selling. I think that's phenomenal, and that's a good thing. So I don't think people will see that as a negative at all. It just means you're at a place where you require the time and energy. It depends on the business. So I wouldn't consider it a negative.
Because at the time when you was talking about the gross margin and the revenue, because that part يعني, get me a little bit confused between these two options, right?
Because you put you haven't launched yet, so you don't have revenues or margins for.
Yes, something like that. Yes.
Yeah, then you would have to show your projections and what you project and what you're thinking and how, based on your pricing that you're going out there and based on the costs that you think are required to run your business, that this business plan or this business model will provide these gross margins. Then we'd be looking at your projections and not your actuals.
Yes.
Because you're earlier on, you're early stage.
I understand. Thank you.
I have a question regarding that. My name is Dawar and I'm from Nuklu Food Delivery, and we have launched in July, and I have created projections for the coming 3 years as well.
Yeah.
And my question here is going back to the gross margin thing, and what if like currently we are not a profit making company at the moment, as if it's part of our marketing strategy to lose in the first year, maybe for 1.5 years, and then start gaining after that once we have a good market share. So in terms of investors, when I show them, let's say, my projections, I'll show them the numbers which I've achieved so far in the first year and what I project to achieve in the coming 2 years. So how do they look at that?
So you have to, so if you're looking, there's a difference between gross and net margins. Are your gross margins positive or are they
Gross
negative?
margin is positive, yeah.
Yeah. So that's what we're looking for mostly is the gross margins, and the net margins. We understand at least, for sure at the beginning. It takes a long time to get to profitability. We look for a path to profitability, but most of the companies we invest into initially, they're not profitable. But we spend time to see, okay, there is a road to profitability.
Okay.
I think it's especially the case with, I guess, platform, services where you depend highly on user base on both ends, right? And so you want to kind of create that critical mass, I guess, of both users, and in your case, though, I guess it's making sure that you have, a significant number of merchants to pose kind of some sort of threat to the incumbents, which is what you're building right now.
Yeah,
exactly. Like our focus has been more on building the merchants and the clients, so that not on making money on every order at the moment.
That's what we would expect to see. But we'd like to see in your projections that there is a road to where you're going to get profitable in the future. You're going to be profitable.
Do you have well, I know this is just a bit, out there, but like at their kind of stage, at an earlier stage, is there kind of I mean, you mentioned in a few places, but I mean, at their specific stage, is there a kind of month over month kind of target which you would kind of expect growth wise, in terms of merchants or users or whatever, or is it like, is there a kind of a magic kind of band which you should be looking at? Oh, you're muted.
If you're growing, I'm just going to do the quick math. If you're growing at 10% per month, you're growing on an annual basis 3x, right? That's great. Those are good growth numbers. If you're growing at 20% per month, you're growing for the year, you're growing your revenue, at least, or whatever the number, whether it's users, et cetera, 8.9, so 9x. And if you're growing at 5%, you're at 1.7x. So I'm like, and if you're at 10, if you're growing 10% per month, we're happy. We think that's a phenomenal growth, at least initially early on.
Okay, then I have so many more questions, but I don't know.
You know what? It's helpful because I think we're at the end of our hour. Well, actually a little bit over. If you want, you can send your questions to Badr. I'm happy to